A home is the biggest single investment in most people's lives, involving hundreds of thousands of dollars in the purchase. Enter the mortgage loan agreement, which is a rather formal way of referring to it. The mortgage loan, or just plain mortgage, was invented around 1190 AD as a means for more people to own land without having to pay the entire amount up front. This created the debtor/creditor relationship, which still exists today in such large purchases. In the early days of mortgages, it was common for the borrower to pay half the value of the property he wished to purchase up front, and pay the remainder over a period of time agreed to by both lender and borrower. The borrower also agreed to pay interest on the amount of money borrowed as compensation to the lender for use of the property without it having been purchased in full. Things have changed little in the basic anatomy of a mortgage, but the laws governing such a process have. The mortgage is most commonly referenced as a home loan, and both terms are used interchangeably. The practice of putting 50% down on the purchase of a home was common up until the Great Depression, when many people were financially strapped and could only afford to rent their homes. President Franklin D. Roosevelt's administration established an alphabet soup of programs under the umbrella of the National Housing Act to open the home loan market to more Americans looking to own a home by creating a secondary loan market designed to back mortgages with a federally established fund. The risk of lending money to someone to buy a house became a risk more lending institutions were inclined to take. The result is that the modern mortgage market has changed little since the 1930s in America. Now a prospective homeowner is able to purchase a home with as little as 3% of the price for a down payment and the pledge to pay the mortgage over a given term. Most commonly, people will put down 20% of the home's cost and agree to a 10 to 15-year term at an interest rate established by the bank. To add to the modern fluidity of the home loan process, a future homeowner can shop around for a lender to get the best loan agreement possible. Based on the individual's credit history, a lender can offer low interest rates, short terms, and other incentives to get a future homeowner to buy from them. Like any other commodity, once a market for mortgages was established, competition in that market wasn't far behind. For the mortgage consumer, this means a real deal can be found. Federal Mortgage Services, financing you need for the home of your dreams.